Welcome to the next episode of Mortgage Minutes, where we demystify the loan process for you. I'm your host, Austin Baker, along with my co-host, Jonathan Bunk. Woo-woo! All right, Jonathan, what are we talking about today?
So for everyone that's watching, your credit score is about to drastically change, and it can be for the better or it can be for the worst. So there's been some new news about FICO, and they're going to roll out a new scoring system this summer called FICO 10.
Yeah. And FICO, it's an acronym for the Fair Isaacs Corporation. They're the entity that sets how our credit scores are calculated by the different credit bureaus. And so this is a super important video. Whether you're a homeowner or not, whether you're a realtor or not, this is going to affect pretty much everybody and everything. Jonathan, what did they say? How many people are going to be affected?
So 110 million people will see their scores change, either by 20 points or less or 20 points or more. So when you think about the U.S. population being 330 million and thinking
It's a lot of people,
and people are 18 or older, it's almost half the population of people that are over 18. So it's going to hit all of us.
And this video is not going to be comprehensive for all the changes that are involved in FICO 10. It's just a few of the things that stood out to us when we read the report. So Jonathan, walk us through this. This is all revolving credit. So
yeah, let's talk about that first. Yeah, so the first thing we want to talk about is the big changes that are happening are around revolving credit. Mm-hmm. And so the main two types is installment credit and revolving credit. And so installment is like you make your mortgage payment every month, you make your auto payment every month, your student loan every month. That's what we call installments. But revolving can be credit cards, home equity line of credits, or unsecured personal line of credit. So things that you have every month that's kind of revolving. So that's where the big changes are really going to come from. So
yeah. So let's go through this. High balances. How are high balances, how's the way that FICO looks at high balancing changing?
Yeah, so it's going to hurt you. The high balance, you have a high balance on any of those revolving credit, it's really going to hurt your score. And so a good example is if you have a HELOC, say you got one to do some home renovations or some emergency repairs, and you just been letting it sit around, say you owe 70 grand and you took out a $70,000 HELOC and the 70 grand still withdrawn. It's still out there. So if you have that for 6 months, 9 months, or a year, that's going to really hurt you.
It's going to hurt for sure. Okay, and that's not something that historically has necessarily hurt you. If you had a HELOC out there and you weren't paying down on it, it's not typically hurting you. It's going to hurt you. Okay, rising balances.
Yeah, so this is another good one. It could be any of those revolving credits. So, a lot of things move like a roller coaster, but if the bureaus and scoring systems seeing like every month your balance is getting higher and higher, and they're not seeing you eventually pay it off and you just have months and months, that's really going to hurt you negatively.
Yeah, so you go get that credit card and you put $2,000 on it month one, and then three, you add another $1,000 the following month. If they see, and they're not just going to be scoring based off of snapshots. They're scoring based off of time. And so this is something to be really paying attention to, rising balances. Okay, this one was particularly interesting to me. High limits.
Yeah, so the easiest way to think about high limit, I think this one probably affects the majority of all of us. A lot of people put all their bills, groceries, gas on a credit card, and they're like, hey, our monthly expenses are $5,000, so we have a credit card that maxes out at $5,500 or $6,000, and so you put $5 grand on it every month,
and you pay it off.
And you pay it off on the 31st or whenever your credit cards due. You never really pay interest. You never let it carry over. But when they see the snapshot of your credit score, when they pull credit, they're like, "Wow, you have a $5,500 credit card and you have $5,000 on it every month."
Yeah,
that's going to really hurt your score negatively, unfortunately.
Yep. So, I mean, this affects me. I'm guilty here. I pay my credit cards off in full every month, but I have one card.
Get those travel points,
Yeah, exactly. Where we're putting everything on it, we're paying it all off, but we're using the majority of the limit on the card. So what can you do?
Yeah, so now let's go back and look at these three, and also I'm going to try to give you some tips. So on the high limit one, the easiest thing you can do is just call your credit card company and say your card was at $5,500. Say, hey, could you approve me for $8,000 or $9,000, whatever it is. So increasing the line of credit that you can have access to now. We're not telling you to spend more on it, but just increasing the limit would help you a lot in the situation.
Yeah, that's a quick phone call and a quick adjustment for most people.
Yeah.
Okay, instead of rising balances, the thing you can do to actually help you is if you do have a balance, make sure that you're paying on that every single month. And so let's say that you've got a credit card, you got some credit card debt out there that you're struggling with. Even if you're just making, incremental payments and they're saying, okay, that was, $15,000 balance one month. Next month, it was $14,800. Next month, it was $14,600, something like that. If you're chipping away at it, it's going to recognize, hey, this balance is improving. And so that's going to be, use this to your advantage. Just flip the script instead of rising,
get them down. Exactly. And the same point with the high balance. So if you have something high balance and you were putting it off to paying it off, I would say start now. Start chipping away at it. Get it down because it will help, preserve your high credit scores or whatever your scores are at right now. That would help preserve them before they can get hit or impacted negatively here.
Yeah, and if you're chilling for a HELOC, it would be a good opportunity to look at doing a cash out refinance potentially to help
pay it off.
Clean that up, especially if you're planning on buying a home later in the year.
Absolutely.
Why is this important? Who should be paying attention? What should they be doing?
Everyone essentially should be paying attention. Your score is going to change by 20 points for the better or for the worse. But for all our potential buyers out there, our real estate agents and referral partners, now's the time to get pre-qualified. Austin and I have a really great system that we can look at and give some cool insights and see the things you can do right now to maybe boost your scores up or mitigate some of the stuff that's going to be coming this summer. That's why we're here.
Yeah, don't take your good credit score for granted. Like if you know, hey, I've got great credit, I don't need to worry about, getting pre-qualified way in advance. You might want to be rethinking that. And realtors, get on your people. Tell them, hey, if we're going to be looking at buying a house, 6, 7, 8 months from now, let's go ahead and get pre-qualified because of this. If nothing else, do it for FICO.
Yeah, exactly. So give us a big smash on that like button, guys, on the YouTube, and big hearts on Instagram and things like that. We appreciate the support and engagement. Drop us a comment, and we'll see you next time.